Inflation Views by Bud Labitan, 2021, Table of Contents, Chapter 1, 1977, Monetary and Social Inflation, Chapter 2, 1978, Purchasing Power and Investor Difficulties, Chapter 3, 1979, Investors' Misery Index, Chapter 4, 1980, Accounting Rules vs. Real Earnings, Chapter 5, 1981, Inflation Acts as a Gigantic Corporate Tapeworm, Chapter 6, 1982, Lower General Rate of Inflation, Chapter 7, 1983, Accounting Goodwill vs. Economic Goodwill. Chapter 8, 2021, Where is the real rate of price inflation today? Chapter 9, 2021, Finding the Wonderful Business. Acknowledgements. This unpublished and unauthorized book reviews Warren Buffett's writing about inflation during the late 70s and early 80s. It is dedicated to the members of the International Society of Value Investors, a group of friends and acquaintances on Facebook. This material comes from Warren Buffett's letters to Berkshire shareholders. Additional material also came from several online sources. These included, the U.S. Bureau of Labor Statistics, BLS, Wikipedia, Time Magazine, ThePeopleHistory.com, Bloomberg, and Barron's. Much of what I have learned in business and economics has come from the letters of Warren Buffett to the shareholders of Berkshire Hathaway Incorporated and the letters and speeches of Charlie Munger. Warren Buffett's writings in chapters 1 to 7 appear without quotation marks for easier readability. My comments and observations in those chapters appear within boxes. The charts and data are included to give readers a better sense of the price inflation rates during that time period. Each instance of the word inflation appears in boldface. Bud Labitan Inflation Views. In 1979, Buffett wrote, "Inflation is man-made, perhaps it can be man-mastered. The threat which alarms us may also alarm legislators and other powerful groups, prompting some appropriate response." During the 1970s and early 1980s, price inflation rates were rising to distressingly higher double-digit levels. Appointed by President Jimmy Carter, Paul Volcker Jr. is widely credited with having ended the high levels of price inflation seen in the United States. Volcker served 2 terms as the 12th chair of the Federal Reserve under U.S. Presidents Jimmy Carter and Ronald Reagan from August 1979 to August 1987. Volcker attended Princeton University as an undergraduate student and graduated with highest honors. Notice that in his senior thesis, titled The Problems of Federal Reserve Policy Since World War II, Volcker criticized the Federal Reserve's post-World War II policies for failing to curb inflationary pressures. In it he wrote, "A swollen money supply presented a grave inflationary threat to the economy. There was a need to bring this money supply under control if the disastrous effects of a sharp price rise were to be avoided." In order to educate younger readers, I constructed this small book from 2 main sources. These writings come from portions of Warren Buffett's letters to shareholders from the years 1978 to 1983. And, this first part is a summary description of inflation from Wikipedia. Price inflation is a general rise in the price level of an economy over a period of time. Our money buys less because a dollar buys fewer goods and services. Inflation reflects a reduction in this purchasing power per unit of money. This is a loss of real value in the medium of exchange within our economy. The opposite of inflation is deflation, a sustained decrease in the general price level of goods and services. The inflation rate is the annualized percentage change in a general price index, usually the Consumer Price Index, CPI. Economists believe that very high rates of inflation and hyperinflation are harmful, and are caused by excessive growth of the money supply. During the COVID-19 pandemic of 2020, the money supply, M2, has been greatly expanded by about 30%. This was done to help citizens and small businesses survive the economic shutdown. In the graph below, notice how the velocity of money transactions has decreased during this same time period. Also, with the COVID-19 pandemic, there is more uncertainty about the coming rate of economic growth and the coming rate of price inflation. In the stock market, the average P/E for the S&P 500 has historically ranged from 13 to 15. The current P/E of 25 is above this historical S&P average. Low or moderate inflation may be attributed to fluctuations in real demand for goods and services, or changes in available supplies during scarcities. However, the consensus view is that a long sustained period of inflation is caused by money supply growing faster than the rate of economic growth. So, we should hope that economic growth will grow faster as the money supply is gradually pulled back. Inflation affects economies in various positive and negative ways. Uncertainty over future inflation can discourage investment and savings. If inflation becomes rapid enough, shortages of goods can occur because consumers begin hoarding. Today, most economists favor a low and steady rate of inflation. The task of keeping the rate of inflation low and stable is usually given to monetary authorities. Generally, these monetary authorities are the central banks that control monetary policy through the setting of interest rates, through open market operations, and through the setting of banking reserve requirements. The Federal Open Market Committee, FOMC, judges that inflation of 2% over the longer run, as measured by the annual change in the price index for personal consumption expenditures, is most consistent with the Federal Reserve's mandate for maximum employment and price stability. When households and businesses can reasonably expect inflation to remain low and stable, they are able to make better decisions about saving, borrowing, and investment, which contributes to a well-functioning economy. Low, as opposed to zero or negative, inflation reduces the severity of economic recessions by enabling the labor market to adjust more quickly in a downturn. Low inflation allows central banks the policy to issue more money and prevent business liquidity traps. But what about now, May of 2021? I decided to review Warren Buffett's writings on the subject of inflation from 1977 to 1983. Buffett's writings in chapters 1 to 7 appear without quotation marks for easier readability. My comments and observations in those chapters appear within boxes. Chapter 1, 1977, Monetary and Social Inflation. In the 1977 letter to shareholders, Warren Buffett mentioned the word inflation 2 times. In 1977 the winds in insurance underwriting were squarely behind us. Very large rate increases were effected throughout the industry in 1976 to offset the disastrous underwriting results of 1974 and 1975. But, because insurance policies typically are written for one-year periods, with pricing mistakes capable of correction only upon renewal, it was 1977 before the full impact was felt upon earnings of those earlier rate increases. The pendulum now is beginning to swing the other way. We estimate that costs involved in the insurance areas in which we operate rise at close to 1% per month. This is due to continuous monetary inflation affecting the cost of repairing humans and property, as well as social inflation, a broadening definition by society and juries of what is covered by insurance policies. Unless rates rise at a comparable 1% per month, underwriting profits must shrink. Recently the pace of rate increases has slowed dramatically, and it is our expectation that underwriting margins generally will be declining by the second half of the year. Costs in the insurance areas were rising at close to 1% per month, or around 12% for the year. For 1977, the reported annual average CPI, Consumer Price Index, was around 6.5%. However, the dangers of rising price inflation in a society can accelerate both the fear, uncertainty, and greed factors that can add more pressure on others to raise their prices in a vicious cycle with a momentum of its own. In 1977, Jimmy Carter began his term as the President of the United States. The cost of gasoline was around 65 cents a gallon. However, the nation was feeling the fear of rising energy scarcity and price increases because of the OPEC oil embargo of 1973. During the 1973 Arab-Israeli War, Arab members of the Organization of Petroleum Exporting Countries, OPEC, imposed an embargo against the United States in retaliation for the U.S. decision to resupply the Israeli military and to gain leverage in the post-war peace negotiations. The first Star Wars opened in movie theaters in 1977. Berkshire Hathaway bought the Buffalo News in 1977. At that time, there was no internet or World Wide Web. Newspapers were still a profitable business because they were the main source of news and advertising. 4 years after publishing a proposal for an idea of linked information systems, computer scientist Tim Berners-Lee released the source code for the world's first web browser and editor on April 30, 1993. Note that later in 1998, in the release of the CPI for January, the BLS began using hedonic-based quality adjustments for its personal computers and peripheral equipment item stratum index. The CPI uses hedonic quality adjustments in item categories that tend to experience a high degree of quality change either due to seasonal changes, as in apparel items, or because of innovative improvements and technological changes, as in consumer appliances and electronics. If we adjust inflation downward because of the improvement in the quality of the goods, some argue this can lead to an underestimation of inflation. Furthermore, the recent pandemic shutdown distorted statistical numbers up and down in several areas that are discussed later in this book. Chapter 2, 1978, Purchasing Power and Investor Difficulties. In the 1978 letter to shareholders, Warren Buffett mentioned the word inflation one time. Workers' compensation was a mixed bag in 1978. In its first year as a subsidiary, Cyprus Insurance Company, managed by Milt Thornton, turned in outstanding results. The workers' compensation line can cause large underwriting losses when rapid inflation interacts with changing social concepts, but Milt has a cautious and highly professional staff to cope with these problems. His performance in 1978 has reinforced our very good feelings about this purchase. Average CPI inflation United States 1978 was 7.62%. Inflation fear was beginning to spread. In my view, fear, uncertainty, ignorance, and greed further fueled this cycle. Interest rates at year-end from the Federal Reserve was at 11.75% following on from the oil crisis of the early 1970s. In 1978, smaller Japanese car imports accounted for half the U.S. import market. The first ever cellular mobile phone was introduced in Illinois. Chapter 3, 1979, Investors' Misery Index. In the 1979 letter to shareholders, Warren Buffett mentioned the word inflation 12 times. Buffett wrote, "But before we drown in a sea of self-congratulation, a further, and crucial, observation must be made. A few years ago, a business whose per-share net worth compounded at 20% annually would have guaranteed its owners a highly successful real investment return. Now such an outcome seems less certain. For the inflation rate, coupled with individual tax rates, will be the ultimate determinant as to whether our internal operating performance produces successful investment results, i.e., a reasonable gain in purchasing power from funds committed, for you as shareholders." In this section, notice Buffett's writings on the concepts of purchasing power and investor difficulties during an inflationary time period. In 1979 the inflation rate rose monthly like this: 9.28%, 9.86%, 10.09%, 10.49%, 10.85%, 10.89%, 11.26%, 11.82%, 12.18%, 12.07%, 12.61%, and 13.29% for December of 1979. The year 1979 included stressful events that made people more fearful. Following the return of Ayatollah Khomeini, Iran becomes an Islamic republic and 63 Americans are taken hostage in the American embassy in Tehran. It was also the year of the 3 Mile Island nuclear accident. China instituted the one-child per family rule in 1979. In 1979, Berkshire Hathaway purchased Precision Steel Warehouse Inc. Just as the original 3% savings bond, a 5% passbook savings account or an 8% U.S. Treasury note have, in turn, been transformed by inflation into financial instruments that chew up, rather than enhance, purchasing power over their investment lives. A business earning 20% on capital can produce a negative real return for its owners under inflationary conditions not much more severe than presently prevail. If we should continue to achieve a 20% compounded gain, not an easy or certain result by any means, and this gain is translated into a corresponding increase in the market value of Berkshire Hathaway stock as it has been over the last 15 years, your after-tax purchasing power gain is likely to be very close to zero at a 14% inflation rate. Most of the remaining 6 percentage points will go for income tax any time you wish to convert your 20 percentage points of nominal annual gain into cash. That combination, the inflation rate plus the percentage of capital that must be paid by the owner to transfer into his own pocket the annual earnings achieved by the business, i.e., ordinary income tax on dividends and capital gains tax on retained earnings, can be thought of as an investor's misery index. When this index exceeds the rate of return earned on equity by the business, the investor's purchasing power, real capital, shrinks even though he consumes nothing at all. We have no corporate solution to this problem. High inflation rates will not help us earn higher rates of return on equity. Ironically, many insurance companies have decided that a one-year auto policy is inappropriate during a time of inflation, and 6-month policies have been brought in as replacements. How, say many of the insurance managers, can we be expected to look forward 12 months and estimate such imponderables as hospital costs, auto parts prices, etc.? But, having decided that 1 year is too long a period for which to set a fixed price for insurance in an inflationary world, they then have turned around, taken the proceeds from the sale of that 6-month policy, and sold the money at a fixed price for 30 or 40 years. Many insurance companies were buying bonds having fixed rates of return. The very long-term bond contract has been the last major fixed-price contract of extended duration still regularly initiated in an inflation-ridden world. The buyer of money to be used between 1980 and 2020 has been able to obtain a firm price now for each year of its use, while the buyer of auto insurance, medical services, newsprint, office space, or just about any other product or service, would be greeted with laughter if he were to request a firm price now to apply through 1985. For in virtually all other areas of commerce, parties to long-term contracts now either index prices in some manner, or insist on the right to review the situation every year or so. Some of our convertible bonds appear exceptionally attractive to us, and have the same sort of earnings retention factor, applicable to the stock into which they may be converted, that prevails in our conventional equity portfolio. We expect to make money in these bonds, we already have, in a few cases, and have hopes that our profits in this area may offset losses in straight bonds. And, of course, there is the possibility that our present analysis is much too negative. The chances for very low rates of inflation are not nil. Inflation is man-made, perhaps it can be man-mastered. The threat which alarms us may also alarm legislators and other powerful groups, prompting some appropriate response. Furthermore, present interest rates incorporate much higher inflation projections than those of a year or two ago. Such rates may prove adequate or more than adequate to protect bond buyers. We even may miss large profits from a major rebound in bond prices. However, our unwillingness to fix a price now for a pound of See's candy or a yard of Berkshire cloth to be delivered in 2010 or 2020 makes us equally unwilling to buy bonds which set a price on money now for use in those years. Overall, we opt for Polonius, slightly restated, neither a short-term borrower nor a long-term lender. B. Chapter 4, 1980, Accounting Rules vs. Real Earnings. In the 1980 letter to shareholders, Warren Buffett mentioned the word inflation 15 times. Our own analysis of earnings reality differs somewhat from generally accepted accounting principles, particularly when those principles must be applied in a world of high and uncertain rates of inflation. But it's much easier to criticize than to improve such accounting rules. The inherent problems are monumental. We have owned 100% of businesses whose reported earnings were not worth close to 100 cents on the dollar to us, even though, in an accounting sense, we totally controlled their disposition. The control was theoretical. Unless we reinvested all earnings, massive deterioration in the value of assets already in place would occur. But those reinvested earnings had no prospect of earning anything close to a market return on capital. We have also owned small fractions of businesses with extraordinary reinvestment possibilities whose retained earnings had an economic value to us far in excess of 100 cents on the dollar. High rates of inflation create a tax on capital that makes much corporate investment unwise, at least if measured by the criterion of a positive real investment return to owners. This hurdle rate, the return on equity that must be achieved by a corporation in order to produce any real return for its individual owners, has increased dramatically in recent years. The average tax-paying investor is now running up a down escalator whose pace has accelerated to the point where his upward progress is nil. For example, in a world of 12% inflation, a business earning 20% on equity, which very few manage consistently to do, and distributing it all to individuals in the 50% bracket is chewing up their real capital, not enhancing it. Half of the 20% will go for income tax, the remaining 10% leaves the owners of the business with only 98% of the purchasing power they possessed at the start of the year, even though they have not spent a penny of their earnings. The investors in this bracket would actually be better off with a combination of stable prices and corporate earnings on equity capital of only a few percent. Explicit income taxes alone, unaccompanied by any implicit inflation tax, never can turn a positive corporate return into a negative owner return. Even if there were 90% personal income tax rates on both dividends and capital gains, some real income would be left for the owner at a zero inflation rate. But the inflation tax is not limited by reported income. Inflation rates not far from those recently experienced can turn the level of positive returns achieved by a majority of corporations into negative returns for all owners, including those not required to pay explicit taxes. For example, if inflation reached 16%, owners of the 60% plus of corporate America earning less than this rate of return would be realizing a negative real return, even if income taxes on dividends and capital gains were eliminated. Of course, the two forms of taxation coexist and interact since explicit taxes are levied on nominal, not real, income. Thus you pay income taxes on what would be deficits if returns to stockholders were measured in constant dollars. At present inflation rates, we believe individual owners in medium or high tax brackets, as distinguished from tax-free entities such as pension funds, eleemosynary institutions, etc., should expect no real long-term return from the average American corporation, even though these individuals reinvest the entire after-tax proceeds from all dividends they receive. The average return on equity of corporations is fully offset by the combination of the implicit tax on capital levied by inflation and the explicit taxes levied both on dividends and gains in value produced by retained earnings. As we said last year, Berkshire has no corporate solution to the problem. We'll say it again next year, too. Inflation does not improve our return on equity. Indexing is the insulation that all seek against inflation. But the great bulk, although there are important exceptions, of corporate capital is not even partially indexed. Of course, earnings and dividends per share usually will rise if significant earnings are saved by a corporation, i.e., reinvested instead of paid as dividends. But that would be true without inflation. A thrifty wage earner, likewise, could achieve regular annual increases in his total income without ever getting a pay increase, if he were willing to take only half of his paycheck in cash, his wage dividend, and consistently add the other half, his retained earnings, to a savings account. Neither this high-saving wage earner nor the stockholder in a high-saving corporation whose annual dividend rate increases while its rate of return on equity remains flat is truly indexed. For capital to be truly indexed, return on equity must rise, i.e., business earnings consistently must increase in proportion to the increase in the price level without any need for the business to add to capital, including working capital, employed. Increased earnings produced by increased investment don't count. Only a few businesses come close to exhibiting this ability. And Berkshire Hathaway isn't one of them. We, of course, have a corporate policy of reinvesting earnings for growth, diversity, and strength, which has the incidental effect of minimizing the current imposition of explicit taxes on our owners. However, on a day-by-day basis, you will be subjected to the implicit inflation tax, and when you wish to transfer your investment in Berkshire into another form of investment, or into consumption, you also will face explicit taxes. Our acquisition preferences run toward businesses that generate cash, not those that consume it. As inflation intensifies, more and more companies find that they must spend all funds they generate internally just to maintain their existing physical volume of business. There is a certain mirage-like quality to such operations. However attractive the earnings numbers, we remain leery of businesses that never seem able to convert such pretty numbers into no-strings-attached cash. 1980, yearly inflation rate USA was 13.58% year-end close Dow Jones 963 interest rates year-end Federal Reserve 21.5% average cost of new house $68,700 CNN, Cable News Network, began broadcasting on June 1, 1980. The American-based network founded by Ted Turner was headquartered in Atlanta, Georgia. It was the first 24-hour news network available to cable TV subscribers. In November of 1980, Ronald Reagan was elected President of the USA. The nation seemed to want an end to a stagnant economy and want a pro-business leader. Who deserves credit? At his first press conference, Fed Chairman Paul Volcker said, "If we are going to progress and prosper, we need a sense of confidence that we are moving toward price stability at home." The country was experiencing an annualized inflation rate of 13%, and the only way to bring about price stability was to raise rates dramatically. During his tenure, Volcker raised the federal funds target from about 11% to 20%. Consequently, inflation fell from over 14% in 1980 to less than 3% in 1983. But the precipitous decline was too late for President Jimmy Carter, who had lost to Ronald Reagan in the election of 1980. Chapter 5, 1981, Inflation acts as a gigantic corporate tapeworm. In the 1981 letter to shareholders, Warren Buffett mentioned the word inflation 14 times. In fairness, we should acknowledge that some acquisition records have been dazzling. Two major categories stand out. The first involves companies that, through design or accident, have purchased only businesses that are particularly well adapted to an inflationary environment. Such favored business must have two characteristics: 1, an ability to increase prices rather easily, even when product demand is flat and capacity is not fully utilized, without fear of significant loss of either market share or unit volume, and 2, an ability to accommodate large dollar volume increases in business, often produced more by inflation than by real growth, with only minor additional investment of capital. Managers of ordinary ability, focusing solely on acquisition possibilities meeting these tests, have achieved excellent results in recent decades. However, very few enterprises possess both characteristics, and competition to buy those that do has now become fierce to the point of being self-defeating. The second category involves the managerial superstars. Over half of the large gain in Berkshire's net worth during 1981, it totaled $124 million, or about 31%, resulted from the market performance of a single investment, Geico Corporation. In aggregate, our market gain from securities during the year considerably outstripped the gain in underlying business values. Such market variations will not always be on the pleasant side. In past reports we have explained how inflation has caused our apparently satisfactory long-term corporate performance to be illusory as a measure of true investment results for our owners. We applaud the efforts of Federal Reserve Chairman Volcker and note the currently more moderate increases in various price indices. Nevertheless, our views regarding long-term inflationary trends are as negative as ever. Like virginity, a stable price level seems capable of maintenance, but not of restoration. 1981 yearly inflation rate USA 10.35% year-end close Dow Jones 875 interest rates year-end Federal Reserve 15.75% average cost of new house $78,200 median price of an existing home, $66,400, average income per year $21,050 Major news stories of 1981 include, the AIDS virus identified, Iran hostage crisis ends, Post-it notes launched, riots in UK cities, Anwar Sadat assassinated. We saw the first flight of the Space Shuttle Columbia. 1981 was also the first year that the word Internet was mentioned. A software operating system, MS-DOS, was released by Microsoft along with the first IBM PC. In politics, a group Solidarity inspired popular protests and a general strike in Poland. The UK government started the process of privatization of nationalized industries. This was later followed by many other countries around the world. President Ronald Reagan appointed Sandra Day O'Connor, the first woman to join the U.S. Supreme Court on July 7, 1981. Notice that 1981 shows a decrease in inflation from 11.83% to 8.92% despite the overriding importance of inflation in the investment equation. We will not punish you further with another full recital of our views, inflation itself will be punishment enough. But, because of the unrelenting destruction of currency values, our corporate efforts will continue to do a much better job of filling your wallet than of filling your stomach. Inflationary experience and expectations will be major, but not the only, factors affecting the height of the crossbar in future years. If the causes of long-term inflation can be tempered, passive returns are likely to fall and the intrinsic position of American equity capital should significantly improve. Many businesses that now must be classified as economically bad would be restored to the good category under such circumstances. A further, particularly ironic, punishment is inflicted by an inflationary environment upon the owners of the bad business. To continue operating in its present mode, such a low-return business usually must retain much of its earnings, no matter what penalty such a policy produces for shareholders. Reason, of course, would prescribe just the opposite policy. An individual, stuck with a 5% bond with many years to run before maturity, does not take the coupons from that bond and pay 100 cents on the dollar for more 5% bonds while similar bonds are available at, say, 40 cents on the dollar. Instead, he takes those coupons from his low-return bond and, if inclined to reinvest, looks for the highest return with safety currently available. Good money is not thrown after bad. What makes sense for the bondholder makes sense for the shareholder. Logically, a company with historic and prospective high returns on equity should retain much or all of its earnings so that shareholders can earn premium returns on enhanced capital. Conversely, low returns on corporate equity would suggest a very high dividend payout so that owners could direct capital toward more attractive areas. The scriptures concur. In the parable of the talents, the two high-earning servants are rewarded with 100% retention of earnings and encouraged to expand their operations. However, the non-earning third servant is not only chastised, wicked and slothful, but also is required to redirect all of his capital to the top performer. Matthew 25:14-30, but inflation takes us through the looking glass into the upside-down world of Alice in Wonderland. When prices continuously rise, the bad business must retain every nickel that it can. Not because it is attractive as a repository for equity capital, but precisely because it is so unattractive, the low-return business must follow a high retention policy. If it wishes to continue operating in the future as it has in the past, and most entities, including businesses, do, it simply has no choice. For inflation acts as a gigantic corporate tapeworm. That tapeworm preemptively consumes its requisite daily diet of investment dollars regardless of the health of the host organism. Whatever the level of reported profits, even if nil, more dollars for receivables, inventory, and fixed assets are continuously required by the business in order to merely match the unit volume of the previous year. The less prosperous the enterprise, the greater the proportion of available sustenance claimed by the tapeworm. Under present conditions, a business earning 8% or 10% on equity often has no leftovers for expansion, debt reduction, or real dividends. The tapeworm of inflation simply cleans the plate. The low-return company's inability to pay dividends, understandably, is often disguised. Corporate America increasingly is turning to dividend reinvestment plans, sometimes even embodying a discount arrangement that all but forces shareholders to reinvest. Other companies sell newly issued shares to Peter in order to pay dividends to Paul. Beware of dividends that can be paid out only if someone promises to replace the capital distributed. Note in the table below the year-over-year gain in industry-wide premiums written and the impact that it has on the current and following year's level of underwriting profitability. The result is exactly as you would expect in an inflationary world. When the volume gain is well up in double digits, it bodes well for profitability trends in the current and following year. When the industry volume gain is small, underwriting experience very shortly will get worse, no matter how unsatisfactory the current level. In recent years, hurricanes have stayed at sea and motorists have reduced their driving. They won't always be so obliging. And, of course, the twin inflations, monetary and social, the tendency of courts and juries to stretch the coverage of policies beyond what insurers, relying upon contract terminology and precedent, had expected, are unstoppable. Costs of repairing both property and people, and the extent to which these repairs are deemed to be the responsibility of the insurer will advance relentlessly. Chapter 6, 1982, Lower General Rate of Inflation. In the 1982 letter to shareholders, Warren Buffett mentioned the word inflation only 3 times. Buffett was seeing signs of price inflation rates moderating lower. Here are the monthly numbers: January 8.39%, February 7.62%, March 6.78%, April 6.51%, May 6.68%, June 7.06%, July 6.44%, August 5.85%, September 5.04%, October 5.14%, November 4.59%, and December 3.83%. For reasons outlined in last year's report, as long as the annual gain in industry premiums written falls well below 10%, you can expect the underwriting picture in the next year to deteriorate. This will be true even at today's lower general rate of inflation. With the number of policies increasing annually, medical inflation far exceeding general inflation, and concepts of insured liability broadening, it is highly unlikely that yearly increases in insured losses will fall much below 10%. 1982 yearly inflation rate USA 6.16% year-end close. Dow Jones 1046 interest rates year-end. Federal Reserve 11.5% average cost of new house $82,200 median price of an existing home $67,800 average income per year $21,050. While 1982 saw the rate of price inflation decreasing, the U.S. experienced an economic recession. Lasting from July 1981 to November 1982, this economic downturn was triggered by tight monetary policy in an effort to fight mounting inflation. A breakup of the AT&T monopoly was ordered during January of 1982. AT&T would give up control of the Bell system, called Ma Bell, that had owned most of the telephone services in the United States and Canada since the 1940s. This agreement came as the result of an antitrust case brought against the company in 1974 by the U.S. Department of Justice. The breakup of the Bell system became effective 2 years later in 1984 when it was split into 7 different independent regional Bell operating companies, informally known as Baby Bells. Chapter 7, 1983, Accounting Goodwill vs. Economic Goodwill. 1983, Warren Buffett mentioned the word inflation 3 times in the general text of his letter and 14 times in the appendix section that discussed the difference between accounting goodwill and economic goodwill. This section is a great teaching lesson. In 1983, Berkshire Hathaway purchased control in Wesco Financial Corporation and Nebraska Furniture Mart. Blue Chip Stamps was merged into Berkshire Hathaway. In recent months much better control over costs has been attained and we feel certain that our rate of growth in these costs in 1984 will be below the rate of inflation. This confidence arises out of our long experience with the managerial talents of Chuck Huggins. For the reasons outlined in last year's report, we expect the poor industry experience of 1983 to be more or less typical for a good many years to come. As Yogi Berra put it, it will be déjà vu all over again. That doesn't mean we think the figures won't bounce around a bit, they are certain to. But we believe it highly unlikely that the combined ratio during the balance of the decade will average significantly below the 1981 to 1983 level. Based on our expectations regarding inflation, and we are as pessimistic as ever on that front, industry premium volume must grow about 10% annually merely to stabilize loss ratios at present levels. We have become active recently, and hope to become much more active, in reinsurance transactions where the buyer's overriding concern should be the seller's long-term creditworthiness. In such transactions our premier financial strength should make us the number one choice of both claimants and insurers who must rely on the reinsurer's promises for a great many years to come. A major source of such business is structured settlements, a procedure for settling losses under which claimants receive periodic payments, almost always monthly, for life, rather than a single lump sum settlement. This form of settlement has important tax advantages for the claimant and also prevents his squandering a large lump sum payment. Frequently, some inflation protection is built into the settlement. Usually the claimant has been seriously injured, and thus the periodic payments must be unquestionably secure for decades to come. We believe we offer unparalleled security. No other insurer we know of, even those with much larger gross assets, has our financial strength. Appendix to Warren Buffett's 1983 letter to shareholders of Berkshire Hathaway Inc. Goodwill and its amortization, the rules and the realities. This appendix deals only with economic and accounting goodwill, not the goodwill of everyday usage. For example, a business may be well liked, even loved, by most of its customers but possess no economic goodwill. AT&T, before the breakup, was generally well thought of, but possessed not a dime of economic goodwill. And, regrettably, a business may be disliked by its customers but possess substantial, and growing, economic goodwill. So, just for the moment, forget emotions and focus only on economics and accounting. When a business is purchased, accounting principles require that the purchase price first be assigned to the fair value of the identifiable assets that are acquired. Frequently the sum of the fair values put on the assets, after the deduction of liabilities, is less than the total purchase price of the business. In that case, the difference is assigned to an asset account entitled excess of cost over equity in net assets acquired. To avoid constant repetition of this mouthful, we will substitute goodwill. Accounting goodwill arising from businesses purchased before November 1970 has a special standing. Except under rare circumstances, it can remain an asset on the balance sheet as long as the business bought is retained. That means no amortization charges to gradually extinguish that asset need be made against earnings. The case is different, however, with purchases made from November 1970 on. When these create goodwill, it must be amortized over not more than 40 years through charges, of equal amount in every year, to the earnings account. Since 40 years is the maximum period allowed, 40 years is what managements, including us, usually elect. This annual charge to earnings is not allowed as a tax deduction and, thus, has an effect on after-tax income that is roughly double that of most other expenses. That's how accounting goodwill works. To see how it differs from economic reality, let's look at an example close at hand. We'll round some figures, and greatly oversimplify, to make the example easier to follow. We'll also mention some implications for investors and managers. Blue chip stamps bought Seas early in 1972 for $25 million, at which time Seas had about $8 million of net tangible assets. Throughout this discussion, accounts receivable will be classified as tangible assets, a definition proper for business analysis. This level of tangible assets was adequate to conduct the business without use of debt, except for short periods seasonally. See's was earning about $2 million after tax at the time, and such earnings seemed conservatively representative of future earning power in constant 1972 dollars. Thus our first lesson: businesses logically are worth far more than net tangible assets when they can be expected to produce earnings on such assets considerably in excess of market rates of return. The capitalized value of this excess return is economic goodwill. In 1972, and now, relatively few businesses could be expected to consistently earn the 25% after tax on net tangible assets that was earned by See's, doing it, furthermore, with conservative accounting and no financial leverage. It was not the fair market value of the inventories, receivables, or fixed assets that produced the premium rates of return. Rather, it was a combination of intangible assets, particularly a pervasive favorable reputation with consumers based upon countless pleasant experiences they have had with both product and personnel. Such a reputation creates a consumer franchise that allows the value of the product to the purchaser, rather than its production cost, to be the major determinant of selling price. Consumer franchises are a prime source of economic goodwill. Other sources include governmental franchises not subject to profit regulation, such as television stations, and an enduring position as the low-cost producer in an industry. Let's return to the accounting in the See's example. Blue Chip's purchase of See's at $17 million over net tangible assets required that a goodwill account of this amount be established as an asset on Blue Chip's books and that $425,000 be charged to income annually for 40 years to amortize that asset. By 1983, after 11 years of such charges, the $17 million had been reduced to about $12.5 million. Berkshire, meanwhile, owned 60% of Blue Chip and, therefore, also 60% of See's. This ownership meant that Berkshire's balance sheet reflected 60% of See's goodwill, or about $7.5 million. In 1983, Berkshire acquired the rest of Blue Chip in a merger that required purchase accounting as contrasted to the pooling treatment allowed for some mergers. Under purchase accounting, the fair value of the shares we gave to, or paid, Blue Chip holders had to be spread over the net assets acquired from Blue Chip. This fair value was measured, as it almost always is when public companies use their shares to make acquisitions, by the market value of the shares given up. The assets purchased consisted of 40% of everything owned by Blue Chip. As noted, Berkshire already owned the other 60%. What Berkshire paid was more than the net identifiable assets we received by $51.7 million, and was assigned to two pieces of goodwill, $28.4 million to See's and $23.3 million to Buffalo Evening News. After the merger, therefore, Berkshire was left with a goodwill asset for See's that had two components: the $7.5 million remaining from the 1971 purchase, and $28.4 million newly created by the 40% purchased in 1983. Our amortization charge now will be about $1.0 million for the next 28 years, and $0.7 million for the following 12 years, 2002 through 2013. In other words, different purchase dates and prices have given us vastly different asset values and amortization charges for two pieces of the same asset. We repeat our usual disclaimer: we have no better accounting system to suggest. The problems to be dealt with are mind-boggling and require arbitrary rules. But what are the economic realities? One reality is that the amortization charges that have been deducted as costs in the earnings statement each year since acquisition of See's were not true economic costs. We know that because See's last year earned $13 million after taxes on about $20 million of net tangible assets, a performance indicating the existence of economic goodwill far larger than the total original cost of our accounting goodwill. In other words, while accounting goodwill regularly decreased from the moment of purchase, economic goodwill increased in irregular but very substantial fashion. Another reality is that annual amortization charges in the future will not correspond to economic costs. It is possible, of course, that C's economic goodwill will disappear. But it won't shrink in even decrements or anything remotely resembling them. What is more likely is that the goodwill will increase, in current, if not in constant, dollars, because of inflation. That probability exists because true economic goodwill tends to rise in nominal value proportionally with inflation. To illustrate how this works, let's contrast a C's kind of business with a more mundane business. When we purchased C's in 1972, it will be recalled, it was earning about $2 million on $8 million of net tangible assets. Let us assume that our hypothetical mundane business then had $2 million of earnings also, but needed $18 million in net tangible assets for normal operations. Earning only 11% on required tangible assets, that mundane business would possess little or no economic goodwill. A business like that, therefore, might well have sold for the value of its net tangible assets, or for $18 million. In contrast, we paid $25 million for C's, even though it had no more in earnings and less than half as much in honest-to-God assets. Could less really have been more, as our purchase price implied? The answer is yes, even if both businesses were expected to have flat unit volume, as long as you anticipated, as we did in 1972, a world of continuous inflation. To understand why, imagine the effect that a doubling of the price level would subsequently have on the two businesses. Both would need to double their nominal earnings to $4 million to keep themselves even with inflation. This would seem to be no great trick, just sell the same number of units at double earlier prices and, assuming profit margins remain unchanged, profits also must double. But, crucially, to bring that about, both businesses probably would have to double their nominal investment in net tangible assets, since that is the kind of economic requirement that inflation usually imposes on businesses, both good and bad. A doubling of dollar sales means correspondingly more dollars must be employed immediately in receivables and inventories. Dollars employed in fixed assets will respond more slowly to inflation, but probably just as surely. And all of this inflation-required investment will produce no improvement in rate of return. The motivation for this investment is the survival of the business, not the prosperity of the owner. Remember, however, that C's had net tangible assets of only $8 million. So it would only have had to commit an additional $8 million to finance the capital needs imposed by inflation. The mundane business, meanwhile, had a burden over twice as large, a need for $18 million of additional capital. After the dust had settled, the mundane business, now earning $4 million annually, might still be worth the value of its tangible assets, or $36 million. That means its owners would have gained only $1 of nominal value for every new dollar invested. This is the same dollar-for-dollar result they would have achieved if they had added money to a savings account. C's, however, also earning $4 million, might be worth $50 million if valued, as it logically would be, on the same basis as it was at the time of our purchase. So it would have gained $25 million in nominal value while the owners were putting up only $8 million in additional capital, over $3 of nominal value gained for each $1 invested. Remember, even so, that the owners of the C's kind of business were forced by inflation to ante up $8 million in additional capital just to stay even in real profits. Any unleveraged business that requires some net tangible assets to operate, and almost all do, is hurt by inflation. Businesses needing little in the way of tangible assets simply are hurt the least. And that fact, of course, has been hard for many people to grasp. For years the traditional wisdom, long on tradition, short on wisdom, held that inflation protection was best provided by businesses laden with natural resources, plants and machinery, or other tangible assets, in goods we trust. It doesn't work that way. Asset-heavy businesses generally earn low rates of return, rates that often barely provide enough capital to fund the inflationary needs of the existing business, with nothing left over for real growth, for distribution to owners, or for acquisition of new businesses. In contrast, a disproportionate number of the great business fortunes built up during the inflationary years arose from ownership of operations that combined intangibles of lasting value with relatively minor requirements for tangible assets. In such cases, earnings have bounded upward in nominal dollars, and these dollars have been largely available for the acquisition of additional businesses. This phenomenon has been particularly evident in the communications business. That business has required little in the way of tangible investment, yet its franchises have endured. During inflation, goodwill is the gift that keeps giving. But that statement applies, naturally, only to true economic goodwill. Spurious accounting goodwill, and there is plenty of it around, is another matter. When an overexcited management purchases a business at a silly price, the same accounting niceties described earlier are observed. Because it can't go anywhere else, the silliness ends up in the goodwill account. Considering the lack of managerial discipline that created the account, under such circumstances it might better be labeled no will. Whatever the term, the 40-year ritual typically is observed, and the adrenaline so capitalized remains on the books as an asset, just as if the acquisition had been a sensible one. Table of historical inflation rates in percent, 1914 to 2021. Chapter 8, 2021, Where is the real rate of price inflation today? Prices of goods and services are rising at different rates, and people have mixed views on this issue. Coming out of the COVID-19-induced recession, some believe that the federal stimulus and spending programs will ignite a multi-year inflationary wave again. Others argue that price spikes in certain sectors like lumber and building products are merely temporary and due to a short-term lack of supply. In my view, price inflation is also an attitude or attitudinal phenomenon that spreads rapidly like fear. Once the ball of inflation starts rolling, it takes time for attitudes and behaviors to change. Who wants to lower their prices when others are still raising their prices? Inflation is measured using a basket of goods and services. The COVID-19 virus disrupted inflation statistics because the pandemic shutdown drove changes in consumption patterns. These changes altered the official pace of price growth in different goods and services. Across the world, people stopped spending on restaurants, airfares, and other lockdown-restricted activities. As a result, some countries' real-world experience of inflation differed from the official rate. And, the U.S. inflation may have been underestimated. Spending on groceries increased 29% in March last year according to Opportunity Insights. In contrast, transport spending declined 70% in April last year. Also, a decline in production of cars and trucks over the past year pushed up used vehicle prices. Some argue that reweighing items in the CPI basket is necessary to more accurately reflect recent price changes. Americans spent less on transport since the start of the pandemic than the CPI weighting suggests. April's official inflation reading, which recorded a big jump, was probably an overestimation. As the U.S. economy reopens and lockdowns end, rate effects may reverse. Katharina Utermol, senior economist at Allianz, said policymakers will need to take note of this and test alternative measurement methods to get a better sense of actual inflation dynamics. Keep an open mind and try to appreciate both sides' views on our U.S. government stimulus issues. Is the current price inflation transitory, or will it be more persistent? On May 19, 2021, Randall Quarles, the Federal Reserve's Vice Chair for Supervision and Regulation, said that the central bank is monitoring inflation. The COVID-19 pandemic is an unprecedented event. Reacting too soon might come at a cost of constraining an economic and jobs recovery. Mr. Quarles said that officials have the tools to tamp down inflation if it remains elevated. The Fed could dial back bond purchases or lift interest rates to slow growth and weigh down prices. In my view, inflation is a fear phenomenon that can spread rapidly across many industries. Central bankers may try to slow down the rate of growth. However, it is more difficult to lower the price of goods and services when a fear phenomenon exists. As of June 2, 2021, the Federal Reserve said that it plans to sell the corporate bond portfolio it bought during the pandemic. The move completes the central bank's transition away from its support of that market introduced as part of a COVID-19 relief program. This is a signal that the economy is heating up, and it may not need as much government stimulus. The Fed plans to start reducing the amount of bond ETFs it holds before winding down its bond holdings by year-end. Their plan is make the sales gradual and orderly. The aim is to minimize the potential for any adverse impact on market functioning and perceptions. The intent is to take into account daily liquidity and trading conditions for exchange-traded funds and corporate bonds. According to the Securities Industry and Financial Markets Association, the overall corporate bond market is more than $10 trillion in size. The central bank recently owned $13.8 billion in bonds and bond ETFs. While this is a small portion of the overall total, the sales send a signal to market participants and their perceptions. President Joe Biden is sounding out different advice as he pursues his economic agenda. He recently spoke with prominent critic Larry Summers on the economy after inflation warnings. As the president proposes significant amounts of new spending through his infrastructure and jobs package, there are concerns about the overall impact on possible price inflation. Summers believes that an inflation scenario is now greater than the deflation risks on which they were originally focused. He fears the economy may be overheating. At the time, the government reported that consumer prices rose 4.2% in April. President Biden's $1.9 trillion COVID relief bill might overstimulate and damage the economy by sparking excessive inflation. Coming back from a once-in-a-century pandemic creates a heightened level of unpredictability. Biden's aides have so far downplayed the risk of inflation. Their view is that the danger of spending too little to recover from the effects of the pandemic exceed the risks of spending too much. In 2020, the Fed introduced new facilities to offer liquidity to companies, state and local governments, smaller businesses, and nonprofits. Those facilities were seeded in part with money from the Treasury Department's Exchange Stabilization Fund. 5 of those emergency facilities expired at the end of 2020. Those are different from the central bank's quantitative easing efforts, where the Fed has continued to purchase $120 billion in treasuries and mortgage-backed securities each month. Depending on how the U.S. economic recovery develops, the central bank is expected to start discussing reducing the pace of those purchases later this summer or fall. What should value investors do? Purchase businesses that are well adapted to an inflationary environment. Warren Buffett said that such a favored business must have 2 characteristics. 1. An ability to increase prices rather easily, even when product demand is flat and capacity is not fully utilized, without fear of significant loss of either market share or unit volume. 2. The business should have an ability to accommodate large dollar volume increases in business, often produced more by inflation than by real growth, with only minor additional investment of capital. However, Buffett also warned us that very few businesses possess both characteristics, and competition to buy those that do will become fierce. So, be careful in your assessment of price and value. Chapter 9, 2021, Finding the Wonderful Business. Use this innovation in behavioral finance. I believe that Warren Buffett and Charlie Munger invented an investing formula and process that is underappreciated by the business and academic communities. This sequential filtering process is effective. These filter steps reduce the risk of investment failure by helping us steer a better path to a high-quality bargain. Charlie Munger has spoken about the merits of having a pilot's checklist. I think the 4 filters are an important checklist because they emphasize an economic understanding of a business, repeat customers, ideal managers, and a margin of safety. Warren Buffett mentioned the 4 filters in the 2007 annual letter this way: Charlie and I look for companies that have a business we understand, b. favorable long-term economics, c. able and trustworthy management, and d. a sensible price tag. These filters enhance the probability of our investment success. They will help us in our search for intrinsic value and sensible investment. The very profitable Coca-Cola investment explained. Coca-Cola is a business with a differentiated and continuing competitive advantage. Its economic moat is deep and wide. Since it has a combination of a special brand advantage, large-scale cost of production advantage, and a global network distribution advantage, we could say that it has three moats around its economic castle. In 1988, Warren Buffett and Charlie Munger began buying stock in the Coca-Cola Company for the Berkshire Hathaway portfolio. They purchased about 7% of the company for $1.02 billion. It has turned out to be one of Berkshire's most lucrative investments. A customer generally asks for a Coke by name. Customers do not buy a cola. Charlie Munger said, "The social proof phenomenon which comes right out of psychology gives huge advantages to scale, for example, with a very wide distribution, which of course is hard to get. One advantage of Coca-Cola is that it's available almost everywhere in the world." Warren Buffett knows that commodity companies sell products or services that can be easily copied and reproduced. In 1982, Buffett said this about commodity companies: businesses in industries with both substantial overcapacity and a commodity product, undifferentiated in any customer important way by factors such as performance, appearance, service support, etc., are prime candidates for profit troubles. Some companies obtain a continuing competitive advantage by being part of a structure that operates as a monopoly. An example of this protected status was Freddie Mac. The Federal Home Loan Mortgage Corporation was established by Congress to buy, securitize mortgages and resell them as guaranteed mortgage pass-through certificates. Until the dynamics changed into a mismanaged overcapacity housing bubble, this had been an earlier profitable investment of Buffett and Berkshire Hathaway. There are also companies that market commodity products so well that they distinguish their commodity product from that of their competitors. These put their own special brand upon their product. They can achieve this by a winning marketing mix of price, product, placement, and promotions. From a practical point of view, business is about taking good care of your customer and arriving at an agreeable trade. In finding the business with enduring competitive advantage, we are finding a business that has been tested by time and its customers. Products, customer satisfaction, great management, and financial safety given by a bargain purchase are very important. Charlie Munger has said that people calculate too much and think too little. Working together, Buffett and Munger produced a remarkable and effective behavioral finance formula. And, within that fourth filter, bargain price, we see Ben Graham's three most important words in investing: margin of safety. So, investing safety is practically ensured by purchasing high quality at a bargain price. Inflation, market excesses, and government excesses will come and go. Warren Buffett wrote that a different set of major shocks is sure to occur in the future and that he will not try to predict these nor to profit from them. However, if he can identify businesses similar to those he has purchased in the past, external surprises will have little effect on long-term results. Buffett said, "We will stick with the approach that got us here and try not to relax our standards." Buffett's teacher, Ben Graham, believed that the value of analysis diminishes as the element of chance increases. In these filters, we decrease the element of chance and enhance our predictive probabilities. So, we should learn from the best, and we work to develop a better network of good information and scuttlebutt. By studying business situations rationally, we improve our decision-making skills. Using the four filters, we decrease the element of chance and increase our probability of focusing and finding a high-quality bargain. After finding high-quality bargains, think about what Charlie Munger said: over many decades, our usual practice is that if the stock of something we like goes down, we buy more and more. Sometimes something happens, you realize you're wrong, and you get out. But if you develop correct confidence in your judgment, buy more and take advantage of stock prices. Learn from experience. Buffett said it like this: "After many years of buying and supervising a great variety of businesses, Charlie and I have not learned how to solve difficult business problems. What we have learned is to avoid them. To the extent we have been successful, it is because we concentrated on identifying 1-foot hurdles that we could step over rather than because we acquired any ability to clear 7-footers. On tech, Charlie Munger said, "Warren and I don't feel like we have any great advantage in the high-tech sector. In fact, we feel like we're at a big disadvantage in trying to understand the nature of technical developments in software, computer chips or what have you. So we tend to avoid that stuff, based on our personal inadequacies. Figure out where you have an edge, and stay there." Charlie Munger said, "If we don't believe we have an advantage, we don't play. If you're going to be an investor, you're going to make some investments where you don't have all the experience you need. But if you keep trying to get a little better over time, you'll start to make investments that are virtually certain to have a good outcome. The keys are discipline, hard work, and practice. It's like playing golf, you have to work on it." Books by Bud Labitan. The 4 Filters Invention of Warren Buffett and Charlie Munger book examines each of the basic steps Buffett and Munger use in framing and making an investment decision. It is a focused look into an amazing invention within behavioral finance. In my opinion, the genius of Buffett and Munger's 4 filters process was to capture all the important stakeholders in a 4-cluster process. Imagine, products, enduring customers, managers, and margin of safety, all in one mixed qualitative plus quantitative process. Quick Guide to the 4 Investing Filters of Warren Buffett and Charlie Munger book is a quick guide to understanding the 4 investing filters of Warren Buffett and Charlie Munger. It is a shorter version of the previous book and is designed to improve your investment thinking. How do you set a price for your stock purchases? In Chapter 4, I estimate an intrinsic value of Apple stock. First, start by trying to understand the qualities of a first-class business. The 4 filters help you optimize your decision-making. Warren Buffett said it best, "An investor cannot obtain superior profits from stocks by simply committing to a specific investment category or style. He or she can earn them only by carefully evaluating facts and continuously exercising discipline." Price to value is about intelligent speculation. It is about decision framing and using the decision filters of Charlie Munger and Warren Buffett. Readers benefit from this book if it stimulates better thinking into the most important factors crucial to decision making. These decision framing ideas can be applied across different asset classes. First, the book presents the 4 investing decision filters in simplified terms. Then, it extends these ideas by looking into the intelligent speculation ideal described by Benjamin Graham in his 10th lecture of 1946. Valuations book offered 30 sample intrinsic value per share business valuations I performed in 2010. In each case the author tried to simulate an approach that Buffett and Munger might take to valuing a business. However, all of the growth assumptions used were my own. No consultation nor endorsement was sought with Mr. Buffett or his business partner Mr. Munger. The examples given are chosen for educational and illustrative purposes. The valuation cases are estimations written in a style that emphasizes a focus on free cash flow and the number of shares outstanding. Readers are also encouraged to think about the business competitive position. In reality, these businesses may outperform or they may underperform any of my projections. Read it and then look at how my predictions actually turned out 9 years later. Coach W software was crafted from my imaginary conversation with Mr. Warren Buffett. The real conversation never occurred. The software-generated conversation did occur on March 5, 2011. The pseudo A.I. Windows software was developed by me, and it is a useful tool in reviewing the concepts developed by Mr. Buffett, Mr. Charlie Munger, and Mr. Benjamin Graham. An easy read, this book starts out as an imaginary conversation filled with useful business and investing ideas generated by the software. Value. Coach W software is an experiment in positive suggestion that delivers valuable insights to the business thinking reader. It makes us think about how man and machine can communicate with each other. Do certain keywords help us become better investing thinkers? The book is structured to both enlighten and entertain. In this way it mirrors a feel-good guide to self-hypnosis in the field of investment thinking. It is important to point out that there is no association or endorsement from Mr. Buffett or Berkshire Hathaway. Coach W software is useful to readers who are new to value investing, and readers who wish to review these great business investing concepts. Sports and Stocks describes ideas about investing in the stock of a winning business. A fun read, it is written from the point of view of a sports fan. Mixing sports talk with investing talk may stimulate your thinking about better investing. The goal is to find HQB, high quality, business, bargain. I present an entertaining read on how to find HQB using the sports ideas of offense, defense, and special situations. This book includes 3 stock valuation examples from 2017. Moats may be the best business book that describes the competitive advantages of profitable businesses. Moats describes the nature of 70 selected businesses purchased by Buffett and Munger for Berkshire Hathaway Inc. It is a useful resource for investors, managers, students of business. Moats also looks at the sustainability of these competitive advantages in each of the 70 chapters. Thanks to Professor Funny Tej Adidam, Ph.D. Chair of the Department of Marketing and Management at University of Nebraska at Omaha, many of his students contributed to the research for this book. Also, thanks are extended to Richard Conrad, CFA, Dr. Malik Suther, and Scott Thompson, MBA for sharing their thoughts, analysis, and feedback. A Fistful of Valuations in the Style of Warren Buffett and Charlie Munger, 3rd edition, 2015. This book offers 5 sample intrinsic value per share business valuation estimations that were first performed in 2010. In each case presented, I simulated an approach that Buffett and Munger might take to valuing a business, based on what they have written and talked about. However, all of the growth assumptions used are my own. No consultation or endorsement was sought with Mr. Buffett or Mr. Munger. How is this portfolio of 5 businesses doing after 5 years? If the reader had invested an equal amount of money in all 5 businesses in 2010, the average annual return would be 42% by the end of 2015.